We will begin with our first witness, Neil Katz, who is managing partner of the law firm of Katz, Bernstein, and Katz in Syosset, New York. Excuse me. He specializes in federal and state income tax issues and matters affecting corporate partnership, estate, and gift taxation. Not only are his clients small business owners, but he is part owner of a small business himself. He practices law with his father. Welcome, Mr. Katz. You have 5 minutes to present your testimony.
Good morning, Chairman Walsh, Ranking Member Schrader, and members of the subcommittee. I appreciate the opportunity to address you today, and I thank you for taking time to learn about the difficulties faced by closely held business owners as a result of the imposition of the estate tax on the business that they have worked tirelessly to create and grow. Your hearing memorandum states in its conclusion that there is not a great deal of credible evidence about the effect of the estate tax on small businesses. While there may not be a significant number of empirical studies on this issue, the business owners who will testify today and the millions of small business owners across our country who are struggling with this issue are all the credible evidence that you should need. Closely held businesses are an integral part of local economies throughout the country. Business owners spend their entire lives investing time, effort, and capital into making a business a success. Many of them would like nothing more than to be able to pass the fruits of their labor and capital on to the next generation. However, as business owners age, the complexities of owning and running a closely held business often become overshadowed by the burden of the estate tax looming on the horizon. The issues faced by business owners and their families start long before death, with the necessity of seeking out professionals to assist with planning to attempt to reduce the exposure that the heirs will face. This planning does not come without a price. To design and implement an estate plan can cost an individual anywhere from $5,000 to $50,000 or more. The plan may call for the transfer of interest in the business to future generations. Often, this decision is one that the owner may not be prepared emotionally or economically to make at that time. During the planning process, business owners are forced to familiarize themselves with the concept of estate tax valuation, and the families need to become prepared for the expediency with which estate taxes must generally be paid. Estate tax value is a concept that accountants, attorneys, legislators, and the Treasury Department have struggled with for decades. There's no clear definition in the statute, and the only guidance we are given is the hypothetical willing buyer, willing seller language of the regulations. Tax experts often differ on the meaning of these rules, and to business owners, this is often impossible to comprehend. The real value of a closely held business is often tied directly to the owners. Ask most business owners what their business is worth in the market, and they will say, without me, the business is worth nothing. Where estate tax valuation differs from reality, it only makes the burden on the business owner and their family even greater. When I was younger, I started collecting baseball cards, and today I still have much of that collection in my basement. Whenever I'm asked why I don't throw out the baseball card collection, I say that it's because it's worth a lot of money. To that, my wife inevitably responds, it's actually not worth anything unless you sell it. To most small business owners, the same principle applies. To them, the only value of the business is the check that they get to take home each week. However, the estate tax valuation concepts force an imposition of a tax as if the business were sold. Further complicating matters is the requirement that the estate tax be paid within 9 months of death. While extensions are available, they are often short-term solutions to a long-term problem. Even Internal Revenue Code Section 6166, the most significant estate tax extension, has its problems. Most businesses do not have the cash reserves or cash flow available to make the payments that are required in the time frame, and many businesses do not qualify for this relief. Planners will thus often recommend that a business owner acquire life insurance to provide liquidity to pay the ultimate estate tax that will be due. This creates an added expense to the business. Depending upon the amount of insurance that is required, the premiums can run tens of thousands of dollars annually if the owner is even insurable. Businesses today are operating on very tight margins. Adding the burden of estate tax to the cash flow of the business can make continuing the operation of the business impracticable. The new owner of the business can often not afford to pay taxes and still have money to pay business expenses and make a profit. Most individuals do not see working to solely pay off an estate tax obligation as the definition of the American dream. There's no benefit to a beneficiary if the assets that they inherit provide them with nothing other than the opportunity to work with no expectation of income. There needs to be some incentive for the owner. As a final point, more than anything, what the small business owner needs is some clarity and certainty in the law. The constant changes in the estate tax law over the past 12 years, coupled with the uncertainty of the future rules, is unworkable. Congress needs to once and for all establish rules that business owners can be assured will survive. Since the enactment of EGTRA in 2001, we have been operating in an impossible environment. The chaos of 2010, which again stands before us on January 1st, 2013, cannot be repeated. Business owners and all taxpayers need and deserve certainty. Thank you again for the opportunity to speak today. I'm happy to answer any questions the members may have.